While most of the world was distracted by inflation headlines and political noise, something extraordinary just happened in global finance. A $22 billion US Treasury bond auction quietly faltered, and the country that refused to step in wasn't China or BRICS. It was Japan. The nation holding over $1 trillion in US debt sent a signal that rippled across markets without making a sound. And the real story. It's not just about one auction, it's about who still believes in the US financial system and who's quietly stepping back. Welcome to Geo Capitalist, where we decode global wealth one power shift at a time. Subscribe to the channel and let's get into it. At first glance, it looked like business as usual, a $22 billion auction of long-term US Treasury bonds. But behind the scenes, the market trembled. Investor demand was tepid, so weak, in fact, that the U.S. had to raise yields significantly just to attract buyers. The headlines pointed to inflation and central bank uncertainty, but that was only part of the story. Japan, the single largest foreign holder of U.S. treasuries, notably scaled back its involvement. For years, Japan's participation in these auctions had been a quiet stabilizer, but this time it stepped aside. A weakening yen and rising yields at home made U.S. bonds less appealing. Instead of making noise, Japan made a choice. That choice rippled. When a pillar of global bond buying retreats, even silently, it sends a message. The mechanics of the sale may appear smooth on paper, but if a trusted buyer like Japan withdraws, the entire system feels it. From bond traders to central bankers, the reaction was swift. Something had changed. In a debt-driven world, even the absence of a bid can speak louder than any press conference. And this time, it wasn't panic. It was quiet recalibration with global consequences. For decades, the U.S. government has relied on a simple formula: run large deficits, then sell treasury bonds to cover the gap. Foreign buyers, governments, central banks, and institutions were essential to making that work. Japan, China, Saudi Arabia, and others played their part. But that model is now under pressure. Foreign holdings of U.S. debt remain high, but new participation is weakening. Japan is no longer buying at the pace it once did. China has steadily reduced its holdings over the past 5 years. And many emerging economies are diversifying their reserves away from U.S. assets, favoring alternatives like gold or domestic investments. The problem isn't a sell-off, it's a slow withdrawal, and that's more dangerous. A sharp crisis might trigger emergency responses, but this is erosion, gradual, strategic, intentional. And it's forcing the U.S. to lean more heavily on domestic buyers or raise yields to attract short-term investors. The deeper risk. This soft exit could transform U.S. debt into a more expensive, less predictable liability. As foreign buyers exit quietly, the cushion that once kept borrowing costs low is starting to thin. And for a country running trillion-dollar deficits, that's not a subtle issue, it's a structural one. When a treasury auction underperforms, the immediate effect is clear. Yields jump to entice buyers. But beyond that, the knock-on effects can be severe. Higher yields today mean higher borrowing costs tomorrow, not just for government debt, but for every corner of the economy. Imagine refinancing a national mortgage every few months. That's what the U.S. does when it rolls over debt. A weak auction means the government is now paying more interest on the same amount of borrowing, and those costs add up fast. With interest payments already above $1 trillion annually, even small rate increases carry massive consequences. The bigger issue is perception. If markets begin to believe that traditional buyers, like Japan, are stepping back, confidence in the system begins to fray. Investors become cautious. Bidders demand more yield, and over time, auctions stop being routine and start feeling risky. This isn't just about finance, it's about trust. A smooth bond market is built on predictability. Take that away, and even minor tremors can turn into economic aftershocks. That's the danger now. Not a sudden collapse, but a slow climb in costs that chips away at America's fiscal stability, one underwhelming auction at a time. A lukewarm auction triggers yield rises, that's obvious. But the consequences go deeper. Every increase in borrowing cost compounds across rolling debt, feeding into an inflationary cycle. More debt leads to higher interest commitments, which in turn exacerbates fiscal deficits, a self-reinforcing spiral. Japan's discretion may have triggered such a scenario. With key buyers absent, the Federal Reserve may once again have to soak up excess supply, a move that risks reigniting inflation or weakening the dollar. The US Treasury market's liquidity buffer is thinner than it seems. It's not hedge fund traders punishing Washington anymore, it's strategic, measured pullbacks. And their impact is systemic. Higher borrowing costs across the entire economy, from infrastructure funding to mortgage rates to corporate credit lines. What's subtle is powerful. Each auction sets the stage for the next. When trust is measured not by headlines, but by tapering demand, the structural cost becomes real, impacting not just Washington's fiscal calculus, but every homeowner, business, and taxpayer reliant on stable interest rates. When a Treasury auction struggles to attract bids, yields must rise sharply to clear supply. That escalation affects not just new issuance, it impacts the recycled debt the U.S. must refinance at higher interest rates. Each point in yield increase multiplies across rolling obligations, turning a silent auction hiccup into a fiscal strain ripple. With foreign demand dwindling, the Federal Reserve may be forced to buy up the slack. But that comes with trade-offs, injecting liquidity risks, reigniting inflation, or weakening the dollar. In effect, Tokyo's restraint operates like a tightening lever on global finance, forcing more disciplined policy, but constraining flexibility. This isn't about dramatic headlines, it's systemic pressure. Think of it as bond vigilantes by omission, governments signaling caution by absence rather than confrontation. The knock-on effect? Borrowing costs rise across the economy. Infrastructure projects become more expensive. Corporate borrowing tightens. Mortgage rates climb, and capital becomes costlier for all. What's subtle is powerful. As each underperforming auction raises the bar for the next, confidence in U.S. fiscal reliability is chipped away. With roughly $1 trillion spent annually just on interest, even modest rate shifts shift the narrative, from cheap borrowing to cautious recalibration. The trust cushion once assumed to exist may now be eroding. Japan's pullback isn't a one-off, it's part of a broader global reassessment. Countries from China to Brazil to Gulf states are rethinking how much U.S. debt is still considered safe, particularly in a world of rising rates and geopolitical friction. Japan's retreat confirms what many analysts suspected. Demand isn't softening at the edges, it's pulling back at the core. And it's not protest, it's pragmatism. Tokyo is choosing domestic stability over automatic alignment with Washington's fiscal needs. This shift empowers other nations, from middle-income economies to EU financial hubs, to reconsider their reserve and exposure strategies. Their recalibrations aren't anti-American per se, but protective. If the world's third-largest economy pauses in funding U.S. debt, it gives others cover to diversify. Reserve portfolios shift toward regional bonds, commodities, or alternative financial systems. The effects don't just hit Treasury yields, they reshape how capital flows through global markets over the next decade. Japan didn't intend to destabilize U.S. borrowing. It simply prioritized internal economic logic over external expectations. But in doing so, it changed the rules. Others are watching. And when more follow, even quietly, the architecture of global finance starts to tilt. Japan may not be a BRICS member, but its retreat from U.S. debt turns the spotlight onto BRICS as a growing alternative axis. The group is advancing initiatives like BRICS Pay, a decentralized payment messaging system designed to reduce reliance on SWIFT and the dollar. While still in development, it symbolizes a deeper push toward multilateral financial infrastructure. This isn't de-dollarization by force, it's by absence. As Tokyo steps back, BRICS gains soft momentum, diplomatically and psychologically. Collective institutions like the New Development Bank, NDB, and the Contingent Reserve Arrangement are already offering lending corridors outside Washington's purview. BRICS policymakers interpret Japan's shift as tacit validation. If even ally-adjacent economies can hedge away from dollar exposure, then devoting capital to BRICS infrastructure or bilateral local currency trade becomes a logical next step, not merely ideological positioning. This is about reserve power, credit alternatives, and supply chain resilience. As trust in U.S.-centric finance phrase, BRICS systems, built around regional currencies and emerging market liquidity, gain credibility. Over time, this may recalibrate where global capital considers risk-free. And while BRICS isn't displacing the dollar today, Japan's move brings new legitimacy to a world where the U.S. is no longer the only financial anchor. Donald Trump is now officially back in the White House as the 47th President of the United States, having taken office on January 20, 2025. His return has reignited economic uncertainty across America's core trading and financial allies, especially in Asia. While the administration has not yet reimposed full-scale tariffs, rhetoric around reindustrializing America and reviewing trade deals has already begun reshaping how partners like Japan plan their exposure to U.S. fiscal risks. Japan, historically, a silent but steady financier of U.S. deficits, is no longer willing to blindly support Treasury auctions in this new era. The calculus has changed. Tokyo's central bankers, facing rising domestic yields and currency pressure, are also navigating new defense expectations under renewed Indo-Pacific alliances. With the Trump administration reviving talks of cost-sharing on U.S. troop deployments and reworking the 2016 bilateral trade terms, Japan's government sees greater risk in continued bond purchases than in scaling back. This is economic hedging dressed as diplomacy. By pulling back from long-term Treasury participation now, Japan gains maneuverability. It's a preemptive firewall, not against the U.S. itself, but against the unpredictability of populist policy swings. In doing so, Japan sends a clear message to other allies. Trust is not permanent. It must be earned and maintained, especially when fiscal commitments are on the line. At first glance, the July 2025 Treasury bond auction appeared routine. The $22 billion in long-term bonds was technically sold, but the details told a different story. Demand from foreign allies was strikingly soft, and yields had to rise aggressively to attract buyers. In plain terms, the U.S. had to pay more because confidence quietly declined. Japan's absence, in particular, wasn't publicized with official statements or dramatic announcements. But within institutional finance circles, it sent a ripple far deeper than any press release could. A country long viewed as the gold standard of U.S. debt reliability had stepped back, not out of confrontation, but out of caution. The result? A chilling realization among other reserve-holding nations that American debt no longer commands automatic loyalty. That's the real shift, not collapse, but recalibration. When trust begins to fade, even slowly, the global system realigns. Institutional investors start reassessing risk. Central banks diversify. BRICS members feel validated. And most critically, Washington's assumption of endless demand begins to crack. This moment didn't grab front pages, but for seasoned observers, it marked a transition. From certainty to calculation, from assumed leadership to competitive legitimacy, The world didn't panic. It pivoted, quietly but decisively. Japan didn't shout. It didn't stage a protest. It simply stepped back, and in doing so, revealed the inherent fragility in America's financial lifeline. A $22 billion Treasury auction quietly faltered, not because of panic, but because trust began shifting. While global headlines focus on flashy crises, the more consequential shifts are often silent. Japan's absence wasn't a statement, it was a structural recalibration. When one of the world's most trusted creditors hesitates to support a US auction, it sends a ripple effect through global debt markets, investor sentiment, and fiscal planning corridors. If you found this breakdown valuable, watch our next video. It connects directly to these quiet but seismic global shifts. And don't forget, Japan refuses to crash its economy on $22 billion's debt auction fails. Subscribe now. Your support powers independent decoding of how global power is reshaping economics, one silent signal at a time. Thanks for watching, and see you in my next video.